Hello, everyone. Thank you all for joining Stablepoint's mid-year market outlook webinar. So we hope everyone's been enjoying their summers and staying cool. We just really appreciate you taking the time to tune in today with your advisory team here, and that includes myself, Chris Griffith, Henry Wheelwright, and Kenneth Startzel. So we're just really excited to get in front of folks in this format. Some of you may remember our webinars throughout COVID and into more recent years, and now our weekly videos, which are a great opportunity to get our timely thoughts out. But today gives us an opportunity to really take a step back from the daily headlines and go deeper really into some of the themes that we're focused on, and really most importantly, some areas where we're getting a lot of questions from clients. So really our goal today is to be more conversational. So I'll be asking Chris, Henry, and Kenan some questions. We'll have a bit of back and forth about where we've been so far this year, which has definitely been another eventful one. And we just want to provide some context around the forces that are driving the markets and the economy, and just how we're positioned looking ahead. So an agenda overview, if you will, that'll involve starting with company valuations, and then we'll move into interest rates and the Fed. We have our new Fed chair. He was just on in the background on CNBC as well. Henry will focus on some artificial intelligence, of course, and the relationship there with inflation. And then coming up before we know it is going to be the midterm elections, which Chris will comment on. And Kenan's going to review Trump accounts, since there's been a lot of talk going on with those going live. And then I'll be revisiting some of our estate planning integrations and capabilities with our Vanilla platform. So before we move into the bulk of our conversation, just a couple housekeeping or firm notes. First off, this webinar is being recorded, so that'll be available on our website and video library and sent around with our weekly email as well. And then for today, we're not going to be doing any live Q&A, but you always know where to find us over email or call, and of course in our regular reviews as well. And then on the portfolio side, we actually recently completed our mid-year account rebalancing. So as a reminder, this is one of our disciplined investment strategies where we do this a couple times a year. The goal is to manage risk and systematically take some profits and then redeploy that across our target allocations for the strategies. So in our reviews, we'll be touching on that, and you'll also be seeing that in your July statements. So with that, enough from me. I want to get into the bulk of our conversation today and want to turn it to Chris, you first, to dive into the markets. I think an everyday topic is how we're at or near all-time highs in the stock market and how much more this can really go on. The saying that we always go back to is trees don't grow to the sky. So would love to hear what your thoughts are on company valuations and maybe in specific areas, and just how we navigate that going forward without just holding our breath.
No, that's terrific, Claire. Thank you for that backdrop. And before I dive into that, obviously want to say thank you to all of our attendees here, clients. Thank you for your trust and your confidence, your advocacy in our practice, and all of us and our amazing support staff who's still out here working hard while we're here chatting with you. We really appreciate it. It means a lot. And honestly, it's really a pleasure just getting up every day, coming to work, knowing what a difference that we're making for people. So thank you for that. So I'm going to talk a little bit about Claire's question around how high are these trees going to grow before we realize they're at the sky and there's not a lot left to go. So I'll talk a little bit about valuation. And I want to kick it over back to Claire. It's got some other questions for Henry, for Kenan. And I think it's probably one of the biggest questions that we get is, when's this party going to end? And I started my career as an intern in the late 1990s. I started as my financial advisory career right before 9/11, in the middle of the tech bubble, in the middle of the tumult that was going on. And those are the kinds of lessons and memories that they stick with you forever. And I think there's a lot of things that are resonating today for those that remember the tech bubble of 26 years ago that do look fairly similar. So I'm going to take a minute. I just want to share a couple thoughts around that. Where do we go from here? Well, on valuation, one of the biggest things that we take a look at are price to earnings ratios. For those of you that have watched our weekly videos, I'm going to share a slide with you now. I have talked a little bit about this in past months, but wanted to do a little bit of a deeper dive today since we have a little bit more time. And what you're looking at here on your screen now is a chart going back 30 years comparing the price to earnings ratio. That's here on the left of the S&P 500, the 500 largest publicly traded stocks in our country, and comparing that to the average. Our 30-year average says, hey, the stock market trades at 17 times earnings. So for every dollar that corporate America earns, on average, their shares trade hands for about $17. And over time, you're going to have deviations from that. One standard deviation, which covers about 2/3 of all occurrences, lower is at about 14 times earnings. One standard deviation higher is at just over 20 times earnings. These have happened a couple times before. You see the extreme lows in valuations. Okay, this is the great financial crisis down here. We got down to as little as 10 times earnings on the S&P 500 for like 36 hours, if you remember, in March of 2009, probably the best buying opportunity of our lifetimes. And we've been above that top line just a couple times, right? This is the tech bubble here that I'm drawing with an arrow. This is the post-COVID peaks before the 2022 pullback. And here's where we're at today. We're actually quite a bit lower now on price to earnings ratios today than we were just like 6 months ago, from up here at about 23 times earnings to today we sit at 20.5 times earnings. So what does that mean, right? Well, one, that means the stock market is rich. According to the last 30 years, it's actually only been trading this high relative to its earnings 2 other times. Both have led to pullbacks in the broader stock market, honestly, mostly led by the big technology companies that took us to those levels. But really what that means is we're less worried, and Henry will talk more about it, about an immediate market pullback. But what does that mean for rates of return from these high levels going out over the next 4 or 5 years? And if you can follow this chart on the right-hand side, some data from JP Morgan, based on the price to earnings ratio that the market's at today, historically, what have we seen for rates of return in the market over the next 5 years? And if you can draw this line and you got better eyesight than me, it takes us to a number of about 5% is your average over the last 30 years, forward kind of 5-year rate of return on the market. That's well below its historical 10 to 11, usually accompanied by a little pullback along the way. So by historical measures, the stock market is getting a little bit, I don't know if I'd say completely overvalued, but it is fully valued to the point where, at least in the S&P 500, it's about as rich as we've seen in the last 30 years. And I think that presents an opportunity for pause, an opportunity for caution, but also, an opportunity to find opportunities that are out there very much so in the market, in the stock market, but also in other areas like bonds, private markets, and other asset classes, that we really like. So I think from where we sit today on valuation, wanted to share that data with you and our general view that we should be optimistic, but cautiously optimistic, know what we own, be guarded around that, and have good expectations that we may have a couple bumps in the road here along the way over the next couple of years.
Oh, looks like you might be muted there, Claire. So I'll take the opportunity just to jump in. Thanks, Chris. I would echo Chris's sentiments for our gratitude for all the trust and confidence. Claire, I'll give you the mic back. I see you're back on.
Yeah, we're getting back to the cadence of the webinar. So always some tech stuff. But no, I was just saying, the cautiously optimistic theme is always ever there. And I think what Chris, you were saying, it just lays a lot of great groundwork on stocks. And we know that nothing really exists in a vacuum. One thing also affecting valuations is interest rates. That's always going to be one of the biggest variables. And a question that always comes up with clients is, and for us too, is what are interest rates really going to do next? So, Henry, pivoting to you, and beyond the corporate impacts, we're thinking about mortgages, bond, cash yields, cost to borrow. So can you just connect the dots with that? What's going on with the Fed now, and how should we think about the second half of the year and beyond?
Yeah, I think it's a great question. And I actually may take a step back just in a conversational standpoint into what Chris said on valuations. And I'm going to screen share just a chart that came up this week from our partners at Goldman Sachs. I mean, almost every day, clients have said to me, hey, if markets appear expensive, if we have geopolitical uncertainty, if we potentially have higher inflation, so we're not getting Fed rate cuts, why has the market been so resilient? I'm going to unpack a few things tied to your question on interest rates, but also unpack where this market is. The first is it is very hard to predict, even in expensive markets, when the music's going to stop. So I'll go away from the tree analogy. I always say at some point the party needs to end. You have to catch a cab home. We've had periods of time, and if you look at your cyclically adjusted PE ratio, periods of time when you're above this line, we've had the market expensive and have it run for a long period. So I always stress to clients, just because the academic metrics mean that we're trading at 21 or 22 times earnings doesn't mean we're going to fall off a cliff tomorrow. And generally speaking, sentiment, the mood that investors have in the market can carry a bull market for much longer. We saw that in the 90s up until 2008, when, of course, the big financial crisis happened. And we're looking at this period of time now where we're running on a pretty epic 14-year period where we've had prices elevated, and yet the market has really been performing at a very high level. And so I'm going to talk a little bit, I'm going to stop screen sharing and say, how do I tie this into Fed and interest rates? Kevin Warsh is having his first congressional appearance. He's on Capitol Hill. I'm going to screen share and just give you a little bit of background on who he is. There's been a lot of talk about the new Fed president and chair. Some of you may be familiar with Kevin Warsh, some may not. Kevin is not a new player, both to the Federal Open Market Committee. He was on the Federal Open Market Committee in 2006, ran all the way to 2011, famously resigned in a potential dispute with Ben Bernanke and some of his policies around balance sheets to get us out of the financial crisis or housing crisis. I thought this was a great slide. Number one is the Federal Open Market Committee. He is the chair, but he's still one out of 12 people controlling votes. And this has been a discussion I've had with a lot of clients, particularly because of the political narrative, the quote unquote connection to the president. There's been a lot of feeling like, oh, goodness, what's going to happen to the markets? What's the impact going to be of the new Fed chair? We have 7 board of governors. Jerome Powell, which I'm going to talk about, the former chair, is still a governor as we speak. We have 4 Reserve Bank presidents, the committee of 12. And I think one of the key views that everybody's trying to unpack is, now that he's in that seat, what does that mean for both interest rate policy and perception around the market? Number one is, as he's doing today in front of Congress, he's trying to reiterate his commitment to independence. This was something that came up in the political narrative, certainly around how he was appointed, and obviously given the relationship with the former Fed chair and the current administration, a lot of people were concerned that he would not stick to an independent nature. He's defending that today. Interest rate policy has really been around something that he's run his academic career on. This is somebody who cut his teeth in M&A and investment banking, worked in Morgan Stanley and M&A in the 90s, quote unquote, a friend of Wall Street. He's been an advocate that it really shouldn't be around core inflation. We got inflationary numbers today that came in later than expected. The expectations were annualized 3.8, came in at 3.5. Part of the reason why the market's responding well today. He's not a big believer in core inflation that doesn't take into account food and energy. It's been much more about this idea of focusing on trim mean inflation, trying to get your outliers, skyrocketing prices, for example, in eggs over the last 12 months, and getting a real litmus test on where your average prices are coming. He's also a big believer that I'm going to speak to, that AI is going to boost some rather significant productivity gains and potentially have some implications on where inflation will be. Balance sheet's a big piece. He's talking about it today. Famously, he resigned from the Fed board, was in disagreement about the expansion of the government balance sheet coming out of the financial crisis. We should expect some rhetoric. And today's comment or headline that I saw on the TV behind me is that, inflation's not going to be here forever, and he's going to be pretty measured about it. I think the last piece that I'll really talk about, which time will tell, is his opinion on financial regulation. Again, I would call him a friend of Wall Street. He's cut his teeth in investment banking. He's always campaigned around less financial regulation, and a big believer right now that we should try to keep a more abstract and open architecture for investment banks to operate in. Partly some of the reasons why I think the stock market has been optimistic since he's been appointed. I think, Claire, a long way of addressing your question. What is driving markets right now? Two things: earnings growth and profit margins, and the potential for Fed cuts. So wait a second. We've seen profit margins running at 14.8% year over year. So you take your profits, X out expenses and taxes for companies, 14.8% is the highest in a decade. Earnings growth is running at 14% year over year. I'll unpack tech and AI and their role in that. But earnings are growing at a very significant pace, and profit margins have not been this high in 10 years. That's part of the reason why the stock market continues to be solid, less volatile amidst those higher prices. Second is the Fed. New Fed chair, an idea that if inflation dissipates at some point in 2027, we're going to get Fed rate cuts. If you start to see interest rates come down, we call it the risk premium. What investors are willing to pay to take on the risk of owning a stock is also relative to the risk-free rate, what they're getting paid in, say, a treasury bond. So as we start to look out 12 months, we're expecting Fed cuts in the first quarter of 2027. We're going to start to see interest rate policy be much more accommodative to higher prices. Not suggesting that we shouldn't be careful, not suggesting that we shouldn't be disciplined, but if you're looking for a reason why the market's been resilient, new Fed chair, favoring Wall Street, potential data going to Fed cuts, and profit margins at a decade high.
Thanks, Henry. I think it would be great to expand a little bit in particular around, for our bond investors. We have a lot of portfolios that are income driven, and specifically speaking to that portion of the portfolio and bonds specifically, could you, talk about the impact of interest rates in that respect?
Yeah, I think it's a great question. And unfortunately, it is tied a bit to what I'll be talking about in AI. We're in a new period of corporate debt and restructuring of balance sheets. And so I'll start short-term interest rates, money markets, CDs. One, I think the benefactors coming out of the pandemic and those many interest rate hikes that we saw in 2021 coming into 2022 is you didn't have to go out very far on the yield curve. You could buy a 2-year bond and get paid 5% or sit in the institutional money market and take no risk. Right now, the Fed overnight rate is at 365, and we're starting to see much more of a traditional yield curve, meaning the further out you go in maturity and duration, the longer the term bond, the more you're compensated in interest. And that is actually very healthy. The 30-year Treasury is now up over 5%. We hover between 4.5 and 4.6 in the 10-year Treasury. And I think one of the bad news for those that are looking to buy a home or expect when mortgage rates are going to drop, we're in a position right now where we think interest rates on the consumer end are going to stay high for longer. What it means for bond investors is you're actually able to capture some decent real yields, meaning what you're being paid minus inflation. And if inflation does come down and we stay in that 4.5 to 5 rate on quality paper, those are really good risk-adjusted returns. Secondly, which I'll talk about, is we're in an AI boom. We are seeing billions and billions of dollars borrowed on corporate balance sheets, something that I'm going to talk about. And the corporate debt market, particularly in large cap tech, is starting now to pay above average yields. So there's some real interesting opportunities, stablecoin clients that are involved in our individual bond portfolio or want to ask questions of the advisory team. We're really barbelling between 5 to 7 year treasuries where we can get paid very well, and some what I call mid to longer duration, high quality paper that we think we'll look back 5 years from now and be very pleased that we bought.
Yeah, and you kind of highlighted the artificial intelligence piece of this and thinking about inflation being one of the core metrics that the Fed is watching. You spend a lot of time paying attention to AI and technology. So what are your thoughts there on the impact in inflation and going forward?
Well, this isn't as they say, hot take on sports radio. I'm not new to say this, but we're clearly in a generational moment right now. AI has transitioned from a software coding story to a global infrastructure story. And what goes along with trillions of dollars being spent, estimated between now and 2032, is a lot of building, a lot of borrowing. From the top 5 tech companies this year alone, almost 200 billion has been borrowed to build out data centers and the like. What we saw just in the last month is prices starting to come up to compensate for some of those expenses. And we've been thinking strategically that inflation might have a different look than it has traditionally out the next 5 to 10 years as we start to think about the infrastructure needed, water, natural resources, power. We've seen utility mergers, direct deals with mega cap companies. And clearly there's likely going to be some price pressure as a result of the payback for all of this capital that's been spent. If you look at some of the capital expenditures predicted, and I believe I have a slide that I'll share on the screen out the next couple years by some of the major players, hyperscalers that will show up, right? These are a lot of the big names that make up 40% of the S&P 500. Here's our spend track coming into this year. We are still believing that we're in the middle innings of the infrastructure AI build out, and it's really causing some dispersion in how the markets are performing. Infrastructure stocks have been leading the way to start the year, where we've seen some of those big Magnificent Seven names really lag. And I think this is a pivotal point right now in the markets, both inflationary, but also looking at how markets are going to perform. The Fed's got a tough challenge. Kevin Warsh is talking about it as we speak. Once we get through high oil, geopolitical politics, inflation is going to start to look at a little bit of the payback and price pressure that is coming from some of the borrowing to make this all happen.
Thanks. Lots of moving parts there, of course. And like we said, nothing exists on its own. It's all a big puzzle piece that kind of impacts each other. And as we're looking ahead, it'll be here just before we know it, thinking about the midterms, every couple of years, whether it's the presidential election or the midterms, people really just want to know how are investors going to be impacted by what's going on in politics. So I think, Chris, this is a good point to pivot to ask you really to talk about the current political landscape with midterms coming up and just what impacts it could have for our clients.
Yeah, Claire, it's a great question, and one that we also get pretty frequently, right? Not just the presidential elections every 4 years, but the midterms in between. They do have an influence on markets, both bonds and interest rates, like what Henry talked about, is also valuations in the stock market, and also that kind of uncomfortable thing that I feel like a lot of us have forgotten about in the last couple of years is volatility. And we got a little dose of that earlier this year on the news around Iran. We got a little dose of that last year in April around the tariff announcements, but generally those are very short-lived, somewhat modest in their overall size of the volatility. And midterm elections do tend to bring a little bit of market volatility to us all, at least over time. So let me share a couple of thoughts and a chart on that, and then maybe share sort of our thoughts around what do we do through that period of time, right? So I'm going to share 2 quick charts with you to help illustrate sort of what we're seeing. And just by way of explaining what you're looking at here is you're looking at the stock market total performance going back to 1970 in midterm election years. And this 0 point here in the middle, that is midterm election day. So we're looking at market performance in this chart, 126, call it 4 months, 126 days, 4 months prior to the elections. And same thing about 4 months after. So if you assume early November elections, this is basically running from now, early July through, March of the following year to say, hey, what's generally going on with the markets as we head into midterm election season? And what you'll notice in the first half, the left side of this chart is, the orange line on average since 1970. Pink is the current party in power lost control, yellow are other scenarios. But across the board, the months leading up to midterm elections tend to be more volatile. I think we're starting to enter that period right now, right? We're about 120 days out, plus or minus, from the midterm elections. And through July, August, September, October, it would be crazy of us not to expect a heightened level of market volatility. Interest rates for bonds, the stock market, most assets will be bouncing around maybe just a little bit more. And there's good reason for that, right? We don't know what the makeup of Congress is going to be. We don't know yet what all of these individuals' policies are going to be around taxes and regulations and what that may mean for financial markets. So what you're seeing on the left half is the uncertainty play out in market volatility. And then what's really, really interesting to see is check out the right half of the chart. From actually the trend starts upwards of a month before midterms, but as you kind of come into midterms and then out the other side, that uncertainty goes away. Whether we like the outcomes or we don't, we know who's in power, what political party, what individuals, and we have a really good idea of what the taxes and the regulations, other moving parts are going to look like for financial markets. So I think over the next couple of months, we would just caution, know that there'll be a little bit more volatility in the market. However, not in any way, shape, or form an event or a piece of news that we would change long-term investment strategies over. And in this last chart, you can actually see where the volatility historically has peaked, and it's been right here in October, with September and November being close seconds around your average volatility, right? The gray bar is every year in the market on average. The blue bar, those midterm election years, gauged by the amount of volatility in the market. And from now, July, really through the midterms, you can really see the departure of midterm years relative to your normal as far as regular volatility goes, day to day, week to week, month to month. So while we don't have a projection on who's going to win the House or the Senate or exactly what that's going to mean, we would just be cautionary around some volatility in the market. As Claire talked about, we finished mid-year portfolio rebalancing last week to take some profits out of some areas that have moved up, take that for some clients as an opportunity to get a little bit more defensive. But long and short, we still have a really good optimistic view on the markets. However, maybe a little bit more choppy over the next 3 to 4 months. And from kind of finishing up my valuation thoughts, Goldman Sachs has a year-end estimate for the S&P 500 of 8,000. We sit today at plus or minus 7,500. So you've got, 7% or so upside to those price targets. Not crazy, very normal, very mundane. So very much like sticking with the path, staying with that long-term focus, but just know that there'll be a few bumps likely, over the next 4 or 5 months.
I think that's terrific comments there, Chris, and just keeping it conversational. I think a few things as you were talking came to mind. Number one is this year has been an unusually low level of volatility compared to previous years. So in retrospect, last year at this point, we already had 7 days of 2% plus moves. We're at 4. We've had 0 at 3, 4, or 5%. So just thinking about the midterms as an event, even if it wasn't a heightened period where there tends to be uncertainty, we're coming into the period with lower levels of volatility. The second thing that you jumped out, in past videos, we've been talking a lot about the market and how we've been trying to stay away from being weighted like the S&P. This year, if you evenly weighted the S&P 500, right, as opposed to being dominant in tech, which makes up almost 40%, and even weighted S&P 500 is up 12%, outperforming the S&P up around 10. That hasn't happened in a while. Second thing is small companies are up 20%. Year over year up 40, first time in a decade. International stocks that we haven't talked about have been outperforming in many areas US stocks. We are finally getting, for our StablePoint clients, exactly what we've been accustomed to. Rebalancing and diversification are going to be a big part of the market going forward. Sorry, Chris, I just wanted to put that in because I think it ties very well into the comments you made around the midterm.
I think it's a great point. And, we sit here, for those that follow indicators like the VIX, the volatility index, we're at 16 today. That's a very, very low level. If you look back the last 5 or 10 years, that's right around the lowest that the volatility has been. And that will spike, like during Iran, that spiked to 45, right, by a relative gauge. So we have been, I'd say, spoiled by a pretty nice long run of low volatility. And so we should be aware of that and just know the difference, right, between volatility and a change in path or risk.
Thanks, Chris. I think that's really good framework for laying out how these time periods can have market volatility and the impacts there. The other piece that comes out of this that we're always thinking about is the legislation on the other side. And that's where the financial planning piece comes into it. And I know we've really had a lot of changes over the last several years. We had the Secure Act, then we had the Secure Act 2.0, we had the big beautiful bill. It's a lot to stay on top of, and this is really where you could lean on us in the areas that it may impact you. And then the latest, just as of after the July 4th holiday, were Trump accounts going live. And I know Kenan did a video on this the other week, but we're getting a lot of questions, and I think it makes sense to revisit those key points. So, Kenan, I think it'd be really helpful to reiterate to everybody exactly what the structure is of Trump accounts, because there's a lot of info going on around out there, and then when it may or may not make sense to actually utilize them.
Thanks, Claire. So as you mentioned, one of the items that came out of the new bill were these new Trump accounts. What are they? These Trump accounts are they're a tax deferred investment vehicle, and they get invested in US indices like the S&P 500. The big takeaway here is that there's a $1,000 seed deposit from the US government, which is essentially free money. These accounts are, as far as eligibility goes, kids born specifically between years 2025 and 2028 are eligible to open these accounts. There's a few different ways to open them. You can fill out tax form 4547. You can also go to trumpaccounts.gov. There's also an app as well. And I want to talk about, how these accounts compare, how these accounts are like an IRA and what happens when a child turns 18. So I mentioned it's a tax deferred investment vehicle and very similar to an IRA. And when a client becomes 18, this account becomes an IRA. So with that, there are certain distributions that are you can use the accounts and the distributions for different reasons. You want to be aware of the tax implications for doing so. For example, if you use a distribution for school, it will be taxed, but it will not be penalized. If you take a distribution from these accounts for another type of reason, it may be taxed and penalized. Let's talk about how much can be contributed in a year and from who. Mm-hmm. So these contributions can basically come from anyone, family members, employers, and the total that you can contribute in a year is up to $5,000, and that's in addition to the initial one-time seed deposit from the government.
Kenan, let me ask you a question here. Talk a little bit, because I'm sure clients are thinking about how does this fit in relative to some of the more traditional tools that we use here at StablePoint, like a 529 or a UTMA, just as far as flexibility and choice. I think that's of interest to the group.
Sure. Thanks, Henry. So as you mentioned, there's a few different options when it comes to saving for children. And we're getting a lot of questions as far as, depending on what your goal is, what's the best account to use for that goal? And I would say, we have custodial accounts, also known as UTMA accounts. There's also custodial IRA accounts for children, and then there's 529s. So what I would say is that compared to a 529, they're different. They're more like an IRA. There's not a whole lot of benefit towards, if your goal is to use the funds for college, there's not a big benefit using the Trump account versus a 529. If the goal is college, 529 is more likely the way to go. I'd say these accounts are more like a Head Start retirement account for kids.
Right. Yeah. Yeah, I think that's been a lot of the misconception too, and it's really a lot around taxes. So, you don't get a tax deduction for that going in. It's really just being aware of what are your primary goals for this account for your child or someone you're related to. And then really just talking with your advisor and saying, okay, where's the best place to allocate those? Because there are a lot of rules around it, right? There's constantly more changes going on in headlines too. I think Ken and I were talking about, corporate contributions and other seed money from elsewhere. So definitely talk to us. I think, there is a place for these accounts, especially if you get that extra $1,000. And then, there's opportunities down the line. If the goal is for retirement, we can think about Roth contributions down the line. There's a lot of different things we can do. And that's why we're always paying attention to these changing rules. But Ken, is there anything else to add as far as the Trump accounts go that you'd want to make sure everybody knew about?
No other big takeaways. I would just say one thing I did want to mention, because custodial UTMA accounts are very popular and compared to custodial IRAs, is that with these Trump accounts, there's no income requirement. So for other types of accounts, a child needs income in order to be eligible to make contributions on their behalf. With these accounts, there is no income limit, so you can contribute up to $5,000 each year if you'd like.
Got it. Yeah, and we'll stay on top of those thresholds, all of that fun stuff for everybody, like we always do. I'm going to stay on the financial planning side and also revisit a video topic that's been top of mind, and it's really always relevant, and that's estate planning. So estate planning is something, it looks different for everyone. It's always very personal, and it can range from being very simple, maybe just direct beneficiaries, to your more complex, comprehensive estate plans involving specific wishes, tax consequences, especially in states with those low estate tax thresholds, multiple properties, blended families, etc. It's really about protection and making sure your intentions are clear. We know it's not something that's ideal to always discuss, and so it's pretty easily put off. But we're really here to be that accountability partner, and we've also enhanced our capabilities to be able to do so. So I know many of you already work with an estate attorney, you've gone through the process, and you have documents that are all on file and up to date. And then some may not have anything in place, or they're, you got your basic documents and maybe are in need of an update. So we've really expanded our capabilities in both those areas. And that's through our partnership with our platform called Vanilla. So this allows us on the side where you've got your documents and you've got your trusts already set up. It allows us to create and integrate with your financial plan illustrations, visualizations, really to clearly understand how assets would flow under your current setup and structure, and where the opportunities may exist for updates, because naturally circumstances change over time, and that's why we're always asking and being nosy about what you have set up. And then on the other side of things, just for getting up and running with basic documents, you're thinking about your will, a durable power of attorney, a healthcare directive. These are really important things to have in place that can be pretty basic. And that's why our Vanilla platform, we are not estate attorneys, but this platform allows you to go through their structure in which it's self-guided, asks you all the correct questions in order to get those documents set up. And then you print those, get them notarized, and they're on file. For your more complex estate questions, definitely makes sense to consult an estate attorney, when it comes to specific wishes or more complex trusts, different properties and everything. So how we can get set up with those basic documents is just getting in contact with us, and we can set you up with a login there. A lot of great resources. And then just in our regular planning reviews, we'll be incorporating more and more the illustrative areas and just really getting a comprehensive overview of your plan as it is, seeing the flow chart, just so things are a little bit more easily understood. So we really like it. Again, getting up and running there and looking forward to utilizing that more with you all. And that was really it as far as our content. I wanted to wrap up, first off, just thanking everyone for taking the time to join us. We know there's a lot going on, headlines all the time, opinions, predictions, just trying to grab your attention and wanting to know what you should be paying attention to. So we appreciate the opportunity to step back and have these conversations with you and really dive into what we're seeing. And then also looking ahead, StablePoint wise, I wanted to give everyone a little preview of what's coming ahead this fall. So many of you have attended or are aware of our big vision event in the fall. We're making a few adjustments this year, and we think it's going to be great to have actually more of an event series. So this gives more opportunities to attend, with your schedules to choose one that works best for you. And then also makes it a little bit more intimate, interactive with some of the experiences and topics there. So definitely look out for more information from us on that. And we just really thank you for all joining. You've got busy summer schedules. Hope everyone's staying cool. And we're here to answer any questions. Again, this will be recorded and sent out to everybody. It'll be on our website as well. But please feel free to reach out to us and we'll be in contact in our regular reviews. And hope everyone takes care and has a great rest of your week.